Good day, students. Once again, I will be doing another exercise in the chapter of contract costing, which is chapter 10. And I am busy or will be doing 10.5. It reads as follows. Opuo Ltd is presently working on a contract that started 4 months ago. At 28th of February 2004, the end of its accounting period. Details of this contract were as follows. So now we are given the details of the contract. And always important when it comes to contract costing that you go and read what is required. So now I will start with the requirements before I begin reading everything. We are required to prepare the contract account in the ledger of Opuo Ltd, show the profit or a loss on the contract for the accounting period ending 28 February 2004, and show also the balance sheet record on the same date, which is the 28th of February 2004. So now we know that we are required to do the ledger account. So now let us start with the ledger account before we read any entries. So now the ledger account is the ledger account for the contract account. Then we say contract account. Then now after the contract account, we know that this account will record all the expenses on the debit side and all the expenses that regard or affect the contract. And if there are transfers will be recorded on the credit side. So now here is the contract account for this exercise, and I will read every entry that took place in this exercise. Then now it says material issued from the storage to the contract site amounted to 130,000 rands. So now it was from material issued to the contract site. So now that will be debiting material control. All the expenses that have to do with the contract, they are recorded on the debit side. All the expenses that increase the contract account are recorded on the debit side. Then we have machinery that was delivered on site, and this machinery amounted to had a value of 270,000 rands. So now the machine was also for this contract. So now this will be recorded on the debit side at the value or the cost of the machine. Then after, we are told that rent was paid on equipment, meaning that there was equipment that we rented, and the rent paid on equipment will be on the debit side, and we have to say rent paid on equipment. Rent paid on equipment, and the amount of the rent is given as 12,300 rands, and we record that as 12,300 on the debit side because it is an expense that has something to do with this contract. Then after, we check for another expense, and it says labor cost incurred amounted to 61,000 rands. Then that will be the cost of labor. Then we record the labor cost on the debit side, and the labor cost is an amount of 61,000 rands. 61,000 rands was the total labor that was incurred. Sorry, the entry must be wage control. The contra entry must be wage control. Then we write wage control on the debit side, which is wages control. 61,000 rands is the amount. We have material that was returned from the site to the main storage. So now we took material out of this site or out of this contract, and it was sent, or it was taken out of the main contract, and it was sent or out of this contract to the main storage. So now transfer to the storage are recorded on the credit side because we are reducing our contract by 4,400 in terms of material, 4,400. And the contra entry will be material control because the material control will be increasing on the debit side, material control. Then after we record another entry, and another entry is the material that was transferred to contract DP29 amounting to 1,700. Because companies, or most of the times companies that are dealing with tenders or contracts, they can have, or they normally have, different contracts. So now material can be transferred from one contract to another contract. So now when that happens, it must be reducing the contract account for the contract that the material is transferred from. Therefore now we record that as 1,700, and the contra entry is the contract in which the material is transferred to. Then after we check again for other entries, and we see the price of the contract that it was 370,000 rands. If there is a need for that, we'll take it into consideration. We are told that the amount received from the client is equal to 90% of the work that was certified by the architect. So now this is only 90% that we see here. Meaning now if the amount that we see, which is 144,000 rands, is 90% of the work that was completed, it means that we have to calculate the original amount of the client, or the original amount of the work that was certified, because this is the bank that will appear on the credit side of the debtors account, which is our client. So now in other words, we have to say 144,000 rands, we divide it by 90%, which is 0.90. Then this will give us the original amount, or the value of the work that was certified, because this is the cash that was received for the work that was certified. However, the value of the work that is certified is the one that appears now as 160,000 rands. That means the value of the work that was certified was 160,000, but we received 144,000 rands. So now if you say 160,000 rands less 144,000 rands, it means by the end of the year the client will owe us 16,000 rands. So now under our data, we expect to have a balance of 16,000 rands, which will appear in the statement of financial position as a debtor, or debtors control, or receivables. The cost of work not yet certified by the architect is 27,000 rands. So now there was work at the end of the period that was not yet certified by the client, and this is the cost of this work. Remember, this is the work that we will sell later on to the client. So now the client will give us cash for this. So now this will be recorded as inventory by the end of the accounting period, because this is an asset to us. It's an inventory. It does have value. We build it, whatever the contractor or the client wanted us to build, or we have done whatever the client wanted us to do. And that work was costing 21,600, but the architect has not yet certified this work. So now it will be an asset as inventory of incomplete work, which will normally be called inventory on long-term contract. Electrical installation done by the subcontract amounted to 19,700. So now that will be electrical installation, and it will be recorded as subcontract because it was done by subcontractors. So now we debit our subcontractors by the amount that they've done, subcontractors, and the amount of the work done by subcontractors amounted to 19,700. We have incurred this expense, yet the work was done by the subcontract. However, it is an expense for this contract. Then now we continue on that same note, and we realize that, or we see that there is an architecture's fee that was paid. An architect, when he came to do the check, or when the architect came to certify the work, which is the work that amounted to 160,000 rands, remember. And so now when the architect came to certify that work, which had a sales value of 160, we had to pay him an amount of 6,100 to certify that kind of work. So now it is an expense that we incur for the contract. Then we write the description as architecture's architects fees, we write that as architect's fees 6,100, the cost that you incur for the architect in order for the architect to certify the work. We have now we have to take into account all other costs, and a next cost is this, which says value of machinery on the 28 question mark, value of the material, there's 23,200, and now we'll take that into account. Let us take this into account immediately before we go to others. So we're just checking how to record the rest. So now we have the value of the machinery by the end of the period. So now we don't know how much the value of the machinery, and we are not given the depreciation. How is it calculated yet? Let us check from the bottom if is there any information regarding the depreciation. Now it says that overheads are absorbed at the rate of 10% of the cost of material used. So now this is another item very important to take into account. So now let me first record the overheads control, overheads now immediately. So now we know that our overheads are 10%, but we still need to know the value of the material at the end of the period, which we already know that the value of the material by the end of the period is given here. Value of the material is 23,200 rands. So now let us calculate the overheads immediately before we do the depreciation. So now our overheads will be counted. Our overheads will be calculated. Overheads control. Our overheads will be the material that was issued to the site, and that material was 130,000 rands, less the material that was returned to the main site, which is 4,400, less the material that was transferred to another contract, and less the closing material, which is 23,200. So now that will give us material available for use. Material available for use will be 130,000 rands minus 4,400 less 1,700 less 23,200. Let me confirm all these amounts. 23,200, yes. Then now from here we can say equal, and we multiply that by 10%, 0.10, and this gives us 10,070. This gives us 10,070. 10,070 is our overheads, which is 10% of the material used. So now we record that as overheads control account, and that will be 10,070. 10,070. So now that will be our overheads, which is instructed to be 10% of the cost of material used. And cost of material is what was transferred or purchased less what was transferred outside this contract, less what was transferred outside this contract, and this was transferred back to the main storage. This was transferred to another contract, and this is the closing stock. So now after you have done that, you get to the amount which is called the material that was used. So now meaning if we say divide by 0.10, material that was available for use, this was material used, this was material used, and we said times that by 10%, and it gave us 10,070. So now this is our overheads as I have shown you all the calculations. So now with that being said, we can go straight to the depreciation for this. It says that machinery is depreciated at the rate of 20% per annum. Machinery is depreciated at the rate of 20% per annum, and it ends there because the next one is head office cost. So now we have to know how much was the value of the machinery, and the value of the machinery that was delivered on the site was 270,000. So now to calculate the depreciation for this, we have to say depreciation, and depreciation will be equal to cost of 270,000. We multiply this by 20%, and if we multiply this by 20%, it will give us the depreciation for the year times by 0.20. It will give us 54,000 rands, which is depreciation per annum. So now we are not looking for the depreciation per annum, we are looking for the depreciation only for 4 months, because I think it was stated that this contract was only for 4 months. Let us check. The machine was brought in the business. The date is not stated. When was it brought in the business? We don't know the date. And we know that it says Opua Ltd is presently working on a contract that started 4 months ago. 4 months ago. There we know that depreciation will have to be for 4 months. So now everything is made very clear that we need the depreciation only for 4 months. It was 4 months ago. So now it is 4 months. Therefore now when we calculate our depreciation, it has to be for 4 months. Then we have to say times by, in this per annum, we times it by 4 out of the 12th month. Then this will give us depreciation only for 4 months. Then we say times by 4 divided by 12. And depreciation for 4 months is an amount of 18,000 rands. So now if we get 18,000 rands as depreciation, then we can say carrying value is equal to cost of 270,000 less 18,000 rands. So now we get to the value of this machine by the end of the year. Less 270,000. This will give us 252,000 rands. So now this is the value of the machine by the end of the year, which is the one that we're supposed to be recording on the credit side, which is the one where they gave us the question mark. Value of the machine by the end of the year is the question mark. So now we know that the value of the machine by the end of the year, which is after 4 months, is 252,000 rands. So now let us record the balance. Then we record balance, carry downs. We record balance, carry downs. Balance carry down, which is balance with regard to machine. And the balance carry down with regard to machine is 252,000 rands. Then we have to record the balance carry down with regard to the material. And we already know that balance carry down with regard to material, there we have it, 23,200 rands. 23,200 rands. This is the balance with regard to material. Balance with regard to material, which is 23,200. Balance of the material by the end of the year. Then we have to check if was there any uncertified work. If there was uncertified work, the value of the cost of the uncertified work should be recorded on the credit side. There was the cost of work not yet certified, 21,600. 21,600 is the cost of the work not yet certified. So now we'll have to record that as the balance on the credit side. Balance carried down, which is the value of the uncertified work. Uncertified work. The work not certified is 21,600 rands. Then after now we can draw the line to balance this if we have recorded all the expenses that were necessary. We still have to check if aren't there any expenses that are still left. We still have to check if aren't there any expenses that are still left. We have done this, and we have recorded the 10%, recorded the carrying amount based on the depreciation. The last one says head office are apportioned on the contract on the basis of 60% of the labor cost. So now we know how much the labor cost. Therefore now from the labor cost we can apply 60% in order to get to the overhead, the head office cost. So now our labor cost is 61,000 rands, and 60% of that they telling us that it is 60% of that they're telling us that it is head office cost. So now we have to record that as head office cost. Record head office cost. Head office cost. And head office cost is calculated to be 36,600 rands. So now I can calculate the total of all my debit side and all my credit side so that I get to the balance of cost of sales. I get to the balance which is the carry down, which is the cost of sales, being the cost of the work that is certified. So now we say 130,000 plus 270,000 plus 12,300 plus 61,000 plus 19,700 plus 6,100 plus 10,070 plus 36,600 it's not 36,600, it's 33,600 or 36,600 equal, that gives us 540. Okay, I think there's something wrong. Let me just confirm my head office cost. Head office cost, it is 6%, not 60%. Sorry for that. 60%, 6%, not 60%. I just incorrectly calculated that. So head office, it is 61,000 times by 6 divided by 100. It is 61. Where is my wage control? 61,000. Let me confirm that. 61,000 times by 6 divided by 100. That is 3,660. So sorry for that. Take note of the head office cost is 3,660. Then we say plus 10,070 plus 6,100 plus 19,700 plus 61,000 plus 12,300 plus 270,000 plus 130,000. That is 512,830. 512,830. 512,830. Then we less the credit side to get to the cost of sales. Less 4,400, less 1,700, less 252,000 rands, less 23,200, less 21,600. That gives us 209,000. That gives us 209,930. That is the cost of the work that was certified. So now the cost of sales we know should be on the debit side, 209,930. Always bring this amount on the debit side because cost of sales are on the debit side. Then we record that as the balance. We record that as the balance that is brought down, which is cost of sales. And the cost of sales is 209,000. So now we have to record the sales amount, and the sales amount is the amount of the debtor, the amount that the debtor owes us. And the amount that the debtor owes us because of the work that is certified is 160,000 rands. I hope you still remember this amount because we were given the cash that was received. and cash that was received was 90% of the value of work that was certified. We were told that the amount received from the client is the value of the is 90% of the value of the work that was certified by the architect for the work completed, 144,000 rands. And we said that 144,000 rands divide by 90% because we are looking for 100% of the amount, and that gave us the full value of the work that was certified, and the full value of the work that was certified was an amount of 160,000 rands, as you have seen that. So now we record the amount that you're supposed to have received from the client. We always record the amount that you're supposed to receive from the client on the credit side as the data. So now if you wanted, you could have recorded the entry here as the name of the data. That is still not a problem. Then after this, now we have to calculate either have we made a profit or a loss. So now here we have a total of the money that is supposed to be received, which is 160,000 rands. But we incur cost of sales of 209,000. So definitely we've made a loss. So now less 209,930. That means we have made a loss of 49,930 rands. So now that will be 49,930 rand. That will be a loss, profit or a loss on the contract. So now this will be recorded as profit / loss, which in brackets is a loss on contract. In brackets, you can just say loss on contract. Loss on contract, which is 49,930 is the amount of the loss on this contract. 49,930 is the loss on this contract. Then now we have to bring the balances as usual. Don't forget that. Bring this balance down. Show you. They bring this balance down, bring this balance down, and bring also this balance down. So now the balance carried down, therefore now there will be balance brought down when they come to the debit side. Then we'll have balance brought down. Balance brought down for the machine or machinery, which is 252,000 rands. Then after we'll have the balance again, balance brought down for the material. For the material, and the balance brought down for the material is 23,200. Then we need balance brought down for the uncertified work. Balance brought down uncertified work. Uncertified work. And work that was not certified amounted to 21,600. 21,600. And after this has been completed, therefore now we have to do the debtors account, or the account of the debtor, where we determine the amount that our client owes us. Then we record the debtor before we do the extract of the balance sheet. The debtor is the amount that the client owed us by the end of the year, after we have compared what was the sales value of the work certified and what we have received. So now on the debit side, we record the sales value of the work that was certified. And the sales value of the work that was certified is an amount of 160,000. So now the contract entry will be contract account, 160,000 rands. Remember, from financial accounting one perspective, for every credit entry, there should be a debit entry. Our data is credited under the contract account. Therefore, now when we go to the debtors account, the debtors account will have to be debited by the contract account, the same amount as 160,000 rands. And we received some cash from the client. And cash that was received from the client will be recorded as bank because it was cash. And cash that was received was 144,000 rands. So now that 144,000 rands was recorded in the information provided, where we received 144,000 rands instead of receiving 160,000 rands. That means the difference will be a data of the difference between the two amounts. Therefore, now we have to strike the difference and we determine how much is the amount of the data. Therefore, now 160,000 rands will be obviously greater. Then we bring that balance brought down 160,000 rands. Therefore, now we'll have the balance carried down, which is the balance of the data to be recorded in the statement of financial position by the end of the year. Balance carried down, it will be 160 minus 144. That will give us an amount of 16,000 rands. 16,000 rands. That will give us 16,000 rands. So now 16,000 rands will be the amount of the data that will appear in the statement of financial position by the end of this period. Therefore, now we'll have our balance brought down, which is a data. Then after we do balance sheet, and our balance sheet is at 28th of February. Again, 28th of February 2004. 28th February 2004. And we start with the assets. And after starting with the assets, we know that we have plant and equipment. Plant and equipment. Our plant and equipment was an amount of 252,000 rands. Then we have current assets. Under current assets, we have inventory, which is inventory of material on site, where we record the inventory of material. Inventory, which is the material that we have on site. The closing balance of the material on site. And material on site was 23,200. And that material on site was from the contract account, balance of the material on site, 23,200. The machinery is 252,000 rands that we have recorded here. This is this one. So now we have recorded material, which is under current assets. Then after, now we have to record another inventory, which is the inventory on a long-term contract. Long-term contract. Long-term contract, which is work in process, in other words, if you want to make it simple, which is the work in process. That is what it means too. This is the work in process, and work in process is an asset. So now this will be recorded as 21,600 rands. 21,600 rands work that is still in process is 21,600. If you want, you can also record that as work in process. Please don't be a bit confused. If you want, you can say work in process / here work in process. And if you want here, you can also say work in process, because this is the work in process. And we know that work in process is an asset. Then now the last part will be to record our data, which is our receivables, the amount that the client still owes us. Receivables, and our receivables is called the retention amount. I did not say it previously, but this is retention data. Retention data. If you want, you can just say contract data or retention data. This indicates that the 16,000 rands is the retention amount, the amount the client keeps in case there is unsatisfactory in terms of the work done. So with that being said, thank you guys. I have done this exercise and I hope you have understood something.